The bond market is pricing inflation plus growth way far higher than the ISM survey itself. Now, okay, but that's not consistent with anything else. The S&P is pricing it at 45, full recession. The NASDAQ, 42, bigger recession. Growth technology stocks, 35, big recession. Copper, 45. The dollar, which year-on-year rate of change also maps, is pricing growth at 40 or just below 40 now. So most asset prices are pricing in a sharp recession. The bond market is not yet doing so. Let's see what happens. For the next couple of months, I'm expecting it to be signaling a full recession, and we'll get to the tipping point where bond yields start to fall. It'll start affecting asset markets. So I'm not a believer we go to new lows. I've done surveys after survey and seen all the surveys on Twitter. 70% of all respondents in crypto and macro think equities go to new lows. Now, if that is the case, then most people are positioned for it. So therefore, the path of pain is the opposite. And I think the market's priced that in. So I think there's no certainties in this world. I can be wrong. But my view, the balance of probabilities are for me that the risk asset market, equities, crypto, have bottomed. We are having a retest. And as the economic data shifts and bond yields come down, that'll drive that further, and it'll be a further hated rally because nobody will understand. We're going into a recession. Why are equities going up? Well, because they already priced the recession. It's their job to be forward-looking indicators. And they're also giving direct transfer payments to people to pay their electricity bills. So I think that monetary policy changes. It also lags ISM. It's kind of a weird thing, and it tells me that M2 bottoms right about now, which is what the crypto markets, I think, have been telling us. They're trying to find this bottoming process. And if I'm right, the economy slows down, liquidity is going to come up, and crypto is going to rally from here. Let's see. But again, I think crypto has put in a low. I think the ETH merge is a very big deal.
Yeah.
I think it's going to drive inflows. Yes, there'll be volatility. Yes, it won't be a straight line. But I think over time, it's going to put some security into the space because it's done and out of the way. Let's see. Let's hope there's no risk around this. It'll die some of the FUD narratives that are currently building as we move into this, which is only normal, and people should question it. And that's without interest rates getting very far. I mean, the US interest rates are 2.5%, and bond yields are at 3%. But that's the problem of a leveraged market. So when you take liquidity away from a leveraged market, if you're paying the interest on your loans and you're not got enough money, so imagine you're trying to pay your mortgage, but your salary keeps going up and down. So i.e. the amount of money you've got is suddenly less, which is what's happening with inflation. It's harder to pay your mortgage. So you won't borrow or spend as much money. That's what liquidity does. So it's M2 is liquidity. Liquidity going up is good for assets. Liquidity going down is bad for assets. Liquidity negative, where it is now, has been particularly bad for assets, which is why we've had a bear market and we're pricing in a recession. So the dollar has been on this screaming bull run. It's now the second biggest bull run since 1996. I'm not sure it's yet peaked. It will do when monetary conditions back off significantly, but we're not there yet. Even if rates come down a bit, it's not clear the dollar will do it because Europe is a big drag. China's a big drag. There's some real issues out there in the global economy that means the dollar is still the kind of shiniest currency and the one that people want to own. But the dollar moving up and down drives asset prices a lot because most things are denominated in dollars. So the dollar going up is bad for the rest of the world. So it's good for the US because you import more goods than you export. Therefore, the prices of goods goes down. For other countries, it's kind of inflationary. But what happens is they export stuff. So Asia is the big exporter. If their currency is weaker, it's also going to bring down the rate of inflation over time. It can't be a black swan by the very understanding that we all know about it. Black swans are risks that we don't understand. So for us, at best, it's like, when does it happen? Sorry, at worst is when does it happen? At best is maybe it doesn't happen. So we all understand the risk, but it's geopolitics. We have no idea how this plays out. I understand that the Russian situation put it to the forefront of people's minds, and it's definitely a possibility. But I don't think China wants to cut itself off from the world, and I don't think the US wants to cut itself off from China yet. So I don't think it's in anybody's interest. It's kind of this stalemate situation where it kind of rises up. It's like North Korea, South Korea. It's not a solution where anybody actually wants to pull the trigger, but they want a position until maybe they can find an opportunity one way or the other to resolve it. There are elements of 1990, and there are some elements of the 80s. Now, everyone uses the 80s as the big example, right? That the Volcker years, right? The reality was the S&P fell 27%. We've pretty much done that then. And 1990, it fell 20%. 1990 was a pretty common garden recession. We had the savings and loan crisis. We don't seem to have a credit event on the horizon. Now, I know other people have thought maybe it's to do with commodity hedging. Well, most of the commodity prices have gone down, so that fear has been alleviated. I don't see it. I think it was just the unwinding of the excess liquidity from the pandemic, and we returned back to where we were back in about 2018. The bond market is confusing me right now, to be honest. I'm expecting yields to come lower. We've seen the economic data come lower. We've seen the oil price come lower. We've seen inflation numbers come lower. We've seen the equity market come lower, and it's been stubborn. And I think it's based on narrative. Also, I have a suspicion it's something to do with the student loans and some hedges around that. I don't know. That's speculation.
How does that work, Raoul, for people who
I don't really know, Ash. I've been trying to figure it out. What is driving this flow? Because it's really inconsistent with everything else.
Right.
And I'm thinking, if you wipe off a debt, there's the other side of the debt, and there's usually a hedge. Usually these things are a spread. So if you're lending people money against it, you'll buy a bond as a hedge. So you have the difference in interest rates between the two, as opposed to worrying about the bond market going up and down. Well, it means that as you raise the discount rate, your future expected cash flows are worth less. Now, the issue is, if you have no cash flows, it's worth a lot less. So we find that these long duration things, crypto and growth equities, they got smashed the most. They were the ones that benefited the most. Now, that's not to say, again, we'll go through this in due course, crypto is not correlated in the longer term to any of these things. It's correlated in the liquidity cycle to the liquidity. But if you look at the chart of NASDAQ and crypto over the last 10 years, I mean, they look nothing like each other.